Hi, I'm Richard Murphy, and this is the 28th in the video series on the importance of tax transparency that I am hosting and which is being made jointly by the University of Sheffield, where I work as Professor of Accounting Practice, the Global Initiative for Fiscal Transparency, and the International Budget Partnership. In this video, we look at tax spillover analysis in some detail, having introduced the significance of these in video 26. My University of Sheffield colleague, Andrew Baker, with whom I co-created the concept of qualitative tax spillover assessments, has this to say about them.
What are tax spillovers? In the GIFT principles, tax spillover assessments are an aspirational form of gold standard tax transparency. Tax systems often reflect very little in the way of conscious design. That is to say, it is more common for them to evolve as a series of idiosyncratic individual decisions across time rather than as part of a coordinated plan. Consequently, very little attention is paid to how those decisions, policies, procedures, and features interact to create a tax system, and whether they cohere to produce a tax system that functions properly as a whole. As a result, it is common for some elements and features of a tax system to pose risks, or to even undermine the operation of other areas and elements of that same tax system. Low corporate tax rates can, for example, encourage the movement of income into corporate structures, which may, over the longer term, negatively impact a country's income tax base. This is an example of a tax spillover. Those same low corporation tax rates can also pose risks to the tax systems of other jurisdictions, especially when they offer such generous tax rates or reliefs that some corporate actors and high net worth individuals are then lured to rearrange their activities and registrations to take advantage of such generosity. This is how a jurisdiction's status as a tax haven can develop. This phenomenon, where features of a tax system impact other features of that same tax system, or features of a tax system elsewhere, are both forms of tax spillover. Reporting on and documenting these spillovers enables governments and international organizations to come to a better appreciation of where the often unintentional and ignored risks in tax systems are, most of which arise as a result of their distinctly uncoordinated and unsystematic design. Methodologies for assessing spillover risk do exist, and indeed our own research has forwarded and developed such a framework. But governments need to work with experts and international organizations to agree and implement a method for assessing and reporting on these spillover risks. We think that conducting tax spillover assessments will enable governments to better understand the design features and flaws in their own tax systems. In addition, they explain how the risk profile within their tax system could be addressed by a targeted program of reform that would help them to achieve their stated objectives more effectively and to improve revenue performance. Putting this information and the findings of such analysis into the public domain will also enable a fuller and more informed public debate on the performance of the tax system and to identify desirable reform trajectories. Conducting a tax spillover assessment will enable some of the following: raise additional tax revenue without increasing or extending the tax base; identification of weaknesses in the functioning of tax law and how and where tax rule enforcement could be made more effective; identifying targeted measures to improve overall fiscal management of the economy; establishing whether incentives and other governments to encourage particular behaviours built into the tax system are delivering on their original intended objectives, or whether they are having distorted unintended consequences, such as exploitable legal loopholes or creating incentives that undermine other parts of the tax base. Determining the extent of tax compliance, including whether groups and individuals are paying their appropriate and correct shares of tax owing, or whether the burden falls inappropriately on the law-abiding or those without means to exploit legal loopholes. Assessing how the Tax Revenue Authority is performing, whether it is adequately resourced, and whether funds are being used to best effect. And finally, evaluating international tax relations and vulnerabilities, especially to specific forms of tax competition pursued by other countries. This is gold standard tax transparency, but we think it should be the ultimate aim of every tax authority, and they should work towards this with civil society actors and the international community.
There is not the time here to explain just how a tax spillover assessment is undertaken, but in essence, the process is quite straightforward, as is explained in Chapter 12 of the Global Initiative for Fiscal Transparency publication, Making Tax Work, that Andrew Baker and I co-authored. The aim of a tax spillover assessment is to appraise tax spillovers in three ways. The first is the way in which spillovers exist within the domestic economy. In other words, how one tax or administrative issue within a country impacts on another tax or administrative issue within the same country. This is a relatively self-contained exercise. The second way to undertake a tax spillover assessment is to appraise international tax spillovers. This process is undertaken in two parts, meaning 3 spillover assessments are undertaken in all. The first international appraisal considers the threat that the tax system of the country being assessed poses to other countries. These are risks generated by it. While the second assesses the vulnerability of the country's tax system to a loss of revenue as a consequence of the tax policies of other countries. In other words, its vulnerability to risks from elsewhere. The tax spillover appraisal methodology rests on the assumption that a good tax or a good tax policy measure is one that should cause no harm to another tax or tax policy measure, either in the same jurisdiction or in other jurisdictions. In this respect, the appraisal system focuses on identifying and alleviating negative, costly spillovers. Since it generally appears that negative tax spillovers are much more commonplace than tax measures that have a reinforcing effect by positively buttressing other parts of the tax system, this should be viewed as a strength of the appraisal system. In the framework that has been developed, risks generated by particular parts of the tax system are scored on a ranking system from 1 to 5. The scores are awarded based on the collation and documentation of actual practices garnered from the impressions of a range of interested parties arising from the interactions and experiences within the tax system. Those interested parties could be drawn from all those referred to in video 5 of this series, who are the government of a jurisdiction, its treasury, its tax authority, if that is different, its legislature, its taxpayers, potential taxpayers, international regulators, and civil society. However, a weighting towards those with practical tax experience might be of benefit. A score of 5 is indicative of bad spillover performance and the generation of high spillover risks or significant spillover vulnerabilities. A score of 1 is the best possible score. The higher the score, the higher the overall spillover risk and vulnerabilities within a tax system. To undertake the assessment, an assessment grid is prepared. Our example uses a grid of 8 squares by 8 squares, like a chessboard. The items to be compared are agreed upon. These can include taxes, aspects of tax administration and government policy. This is what a UK domestic tax spillover assessment grid might look like. To complete the grid, the topic on the top horizontal line is considered first, and the extent to which it is undermined by the topics listed on the vertical column on the left is then considered. If the risk is high, the rating is 5. If it is low, the rating is 1. I stress that the rating is subjective. It could be prepared by an individual, it could be agreed upon in group discussion, it could be an aggregate of individual scores. A great deal of time could be spent on each question. Alternatively, quick reactions could be sought. We think both are useful and deliver benefits. It would be good to summarise the reasons for reaching a conclusion in either case. This is what our version of the completed UK domestic tax spillover looks like. We suggest colour-coding the grid to emphasise risk ratings. In this assessment, nothing was rated as 1, which would be coloured pale green, or 2, which would have been pale blue. The spillover assessment shows that the UK domestic tax system is heavily undermined by threats from the country's tax politics, which have been antagonistic to tax, an underfunded tax administration and a weak company and trust administration system that facilitates fraud. Vitally, this shows that even if a tax system looks to be internally coherent, it can be undermined by poor administration, poor political support, or lack of government funding. A complete tax spillover assessment would involve completing 3 8x8 grids. A neutral mark in each square would be 3. A neutral tax system would have a score of 192 in that case for each grid. A higher score represents a risky tax system. A lower score is a low-risk system. Tax spillover appraisal can be less complicated and costly to deliver than a tax gap analysis, although we tend to think a tax spillover assessment is best seen as a way of explaining a tax gap analysis. The purpose of a tax spillover analysis is to inform debate on the development of an effective tax system for a jurisdiction. That is why we think that they are important and a vital component in the armoury of tax transparency aimed at delivering tax systems that work for the best benefit of everyone in a jurisdiction.